Yes, your Crypto Blood, and welcome to another episode of My 2 Cents. This morning, we're looking at the Fed. Boston Fed head said some shocking things at a meeting he actually had in New York. It was the Forecasters Club of New York, and Eric Rosengren, the Boston Fed head, said some crazy things and really an admission as to what they should be doing. We're going to take a look at that. It shouldn't be really shocking, to be honest with you, because it just shows that their actions are what we should be looking at, not what they say up at the podium.
But before we start, if you guys find these types of videos informative, make sure you like, share, and subscribe, and click that bell to receive more videos like this.
Let's take a look at the market, how it ended yesterday. We've got Dow Jones up 31 points, up 0.11%. Keep eking out higher gains here, people. The melt up continues, and gold has been on a slight move up the last few days, but the overall trend is still downward. We would have to see a breakout above, I would say, 1490 to see possible trend reversal, but ultimately we would have to see gold get back above 1500 for me to truly be more bullish on gold at the moment. And I'm sure the Fed is looking at things like Amazon, a bellwether in the stock market today. Well, they're on pace to have their worst year in 3 years. So I'm sure these are the types of things that really behind those closed doors at the FOMC meetings, this is what they're looking at, the superficial stuff, how stocks are doing, how the ones that everyone, the common folks in America look at, those stocks, Apple, Amazon, Google. These are the stocks that they want to keep propped up by any means. We've only got, maybe 13, 14 days left in the month. So looks like they're going to close out this year as a bad performing year. Amazon is, and the worst in 3 years. So again, these I think are the things that the Fed unfortunately shouldn't be, but unfortunately are looking at. And then you have stuff like this going on, guys. WeWork arranges a $1.75 billion credit line with Goldman Sachs, and this is only part of a $5 billion plan to get liquidity. I mean, this is just insane. This is what happens when money is cheap, so your risk is low. So, you'll have Goldman Sachs do this crazy stuff. It says shared workspace operator WeWork said on Tuesday it has arranged a $1.75 billion letter of credit with Goldman Sachs that is in the process of being syndicated and whose funds are expected to be available in January. The line of credit is part of a SoftBank Group Corp's $9.5 billion bailout that was announced in October when money-losing WeWork was on the brink of running out of cash after its plans to go public were abruptly withdrawn a month earlier. The three-part bailout included a tender offer of up to $3 billion to buy privately held WeWork shares, the acceleration of the $1.5 billion payment from SoftBank that was due next year, and some $5 billion in new debt, including the line of credit. Why are we assisting a company, a zombie company, to continue to operate in the marketplace? This is not capitalism, people. This is not capitalism at all. And I'm pretty sure they were tapped on the shoulder by Washington, D.C. to make this type of stuff happen so that we can keep this rosy narrative going like everything is fine. Markets are just doing great and nothing's wrong here. But what happens when credit freezes up? This type of stuff won't be done, and subsequently WeWork wouldn't be here. And I'm predicting that this is exactly what will happen in the next couple of years. WeWork won't be able to continually get these lines of credit because even though $5 billion sounds like a lot, this company is bleeding cash on a quarterly basis. So $5 billion won't last too long. But let's take a look at what the Fed out of Boston has said in a Q&A meeting, again, at the Forecasters Club of New York. It says that there was a stunning admission by the Boston Fed head, Eric Rosengren, on Tuesday when during an audience Q&A after a speech to the Forecasters Club of New York, the voting FOMC member and chronic dissenter, Rosengren, has voted against all three rate cuts made by the Fed this year. The former Dove warned that lower rates could encourage excessive risk-taking. Oh, like WeWork, right? And Goldman Sachs, that's excessive risk-taking. SoftBank, excessive risk-taking on another level. And he says over-leveraging, which would create great risk during a downturn. More importantly, he confirmed that high asset prices are a direct function of low rates and thus Fed policy. And it is the Fed that is responsible for not only all prior bubbles, but the biggest one of them all, the one right now. So Rosengren said he does have concerns about the financial stability. He would prefer probably a different level of rates, the Boston Fed president said, confirming that low rates will eventually result in financial crisis and that only higher rates can lead to a final outcome that is not apocalyptic. Rosengren said that following 3 rate cuts this year and the launch of QE4, he remains worried that lower rates could encourage corporations to take on excessive risk and borrow too much. The policymaker said companies that are over-leveraged may have to lay off more workers in a downturn, which could amplify losses and cause more damages to the economy. That's certainly true. Most importantly, the Boston Fed confirmed what we have been saying all along. The Fed should be worried not just about economic inflation, which remains muted, but also asset prices, which have been gripped by runaway inflation over the last decade. He said, if you look at the last 2 recessions, they were not situations where inflation got out of control. They were situations where asset prices went way up and then came way down. So if your goal is to avoid a recession, he says he thinks we need to be pretty focused on asset prices, not just inflation. And look at this chart. This is a great illustration of where we are with things. And, I have to be very critical of Trump when he bullies and pressures the Fed to continue to lower interest rates, because really what Trump is doing is trying to put the window dressing on. He's not really trying to, in this particular strategy, rebalance things when it comes to equity markets. He knows that the equity markets having higher prices is a marketing tool. It's an optic thing that looks good for him in the 2020 election. So he wants to do that. Can you blame him? Not really, not really. If he were to really clamp down on things, let the Fed higher interest rates, the stock markets would crash drastically, and the already opposing liberal media would just have a field day. So maybe what he's looking to do is just at least get reelected and then start to address some of these things, because he's not the type, in my opinion, that is looking to shaft the middle class everyday person, because his efforts in these China talks and this trade deal is not a sexy thing. And there would be a scenario where we would take 3 steps back to walk 5 steps forward when it comes to this trade deal, because it's something that won't have an instant gratification scenario or outcome. So what he's doing there, pressuring the Fed, is definitely a selfish move and on his behalf to keep things looking rosy for his campaign. But in doing so, look at what happens. We have S&P 500 asset prices. Look at total return performance in local currency since January of 2009. Almost 250% returns in the S&P 500. And it kind of just goes down from there. Gold, not even up 25, maybe 25% in 10 years. And they need to have Bitcoin on here. It would just dwarf all of it with thousands and thousands of percent returns for Bitcoin as an asset class. But as we head down toward real assets, you see housing prices barely up. U.S. wages up even less than 25%. Shockingly enough, commodities down 50%. That lets you know, guys, deflationary in commodities, but it's all running into the stock market. That's where all the asset appreciation or inflation is running. And Rosengren's conclusion, if what you want to do is avoid recessions in the future, you have to be thinking about what is happening to asset prices as well. But this will be ignored by everyone, of course, from investors to policymakers, because if the Fed admits that Rosengren is right, and the Fed has to start paying attention to the hyperinflation it has created across asset classes, then the party is over. It's even worse when considering that the Fed has blown such an asset price bubble in equities and other asset classes that the only possible outcome is either for the bubble to burst or to keep growing exponentially, making the resulting crisis far worse. And of course, while the Fed may still be ignoring what is so blatantly obvious to everyone else, problem is that increasingly more ordinary people are realizing that in a time when the S&P is up 27% and wages are barely higher for the 10th consecutive year, there is something catastrophically wrong. And that thing that's wrong is called monetary policy. And before we get out of here, I do want to go over this article out of Business Insider, and it really relates to what we just read. I had it pinned for a couple of days now, and thought it would be of relation to what we just read regarding Boston Fed opinion about interest rates in the Federal Reserve. So before his death, the legendary Fed Chief Paul Volcker issued one last warning to the U.S. The legendary Federal Reserve Chairman Paul Volcker had a final warning for the American public that is losing trust in the government and one another. And this afterword in Volcker's upcoming autobiography was actually made 3 months before his death. In it, Volcker condemned President Donald Trump's efforts to pressure the Federal Reserve to lower interest rates to juice U.S. economy growth already undergoing its longest sustained expansion. He He painted a very bleak portrait of the nation's political environment, saying that nihilistic forces were forcefully rolling back protections considered emblematic of Americans' democracy. He also said that not since just after the Second World War have we seen a president so openly seek to dictate policy to the Fed. That is a matter of great concern, given that the central bank is one of our key governmental institutions, carefully designed to be free of purely partisan attacks. Well, I just have to interject there, and this is where, they blur the lines, because the Federal Reserve is not a governmental institution. It's just crazy how they blur those lines. But Volcker also said he trusted that the members of the Fed would fend off any attempts to interfere in its monetary policy decision making so that it may act free of partisan political purposes. The former Fed also said that increasingly, by design or not, there appears to be a movement to undermine Americans' faith in our government and its policies and institutions. We've moved well beyond former President Ronald Reagan's credo that government is the problem, with its aim on reversing decades of federal expansion. Today, he said, we see something very different and far more sinister. Nihilistic forces are dismantling policies to protect our air, water, and climate, and they seek to discredit the pillars of our democracy: voting rights and fair elections, the rule of law, the free press, separation of power, the belief in science, and the concept of truth itself. You guys let me know your 2 cents on that. Do you think Paul Volcker is correct in his assessment of what's going on and what Trump is doing in regards to pressuring the Federal Reserve to keep interest rates lower? As I've stated before, I understand why he's doing it. It's just that it really is to no benefit to the American people. But at the same time, we're so far down this rabbit hole, it doesn't matter if Trump decides to pull interest rates to 10% tomorrow. It's a lose-lose situation, and it will cause issues for many, many years, longer than anyone would be willing to endure. So it's like, hey, might as well keep this going as long as possible. At least not have a self-inflicted or self-induced event to cause this thing to unravel. Let it unravel by a black swan or something. That's what any person in power would do. And that's even on the Federal Reserve side. They knew that they couldn't continue to raise interest rates and do quantitative tightening. There's no way they could have unloaded their balance sheets. They were just doing that for optics. It was an optics thing where they wanted to just show that, oh yeah, we're in control of things, and we know what we're doing, and we're not forced to go back to zero. So that's all that was. The Fed too knows that they can't higher interest rates, So are they really being bullied? Probably not. They're probably like, woo, thank you, Trump, for rescuing us from not having to look like even more of a fool when we go in public and speak at these various conferences. Again, you guys let me know your 2 cents on the situation. Is the Boston Fed chair correct in his assessment? And is the late Fed chair Paul Volcker right in his assessment of things? If you found this video informative, make sure you guys like, share, and subscribe, and click that bell to receive more videos like this. I'm out of here, people. Holla.